So with this, because I wanted to give why we were permitted to do. So instead of doing that, I have just deleted all from my memory. I would start with what is my interaction with NDF and why I am very deeply connected to NDF. Since 2012 to 2016, and that included the period of taper tantrums, which is now historical, I was head of State Bank of India's treasury operations in US. And as the timing difference goes, we were just permitted to do one activity, that is to sell Indian rupees to whoever wants to buy. And at that time, it was my dream, rather a wish inside, we can't say it outside, but inside, that can Indian banks one day be, or will I be one day permitted to trade in NDFs? Because NDF now becoming, with the increased globalization, it is but natural that currency had to become international. And emerging market, with the increase, the data was already shared today in one of the earlier, that they had to become the kind of internationalized currencies, including emerging market. So there was to be a time. And then finally, from 1st June 2020, NDF was permitted to us. So this step which was taken by RBI, of course ma'am was there, which allowed the Indian domestic banks to also participate in the NDF market, as well as later on the regulations were further, the fillip was given so that domestic entities also could participate in NDTFs. So ma'am, my first question to you would be, I would like to understand from you the RBI's perspective and vision at the time of introduction, or rather allowing Indian banks, those banks which have a presence in Gift City, those having Gift City IBUs, to permit them to trade in this, ma'am.
Thank you. Actually, I don't know what to say. I think sir has spoken, you have spoken. Very much what my ED mentioned, what Samir sir mentioned, if all of you have been in markets, you have to look at a package. You know, it's 1 rupee traded in different venues of the world, but it's the same rupee. It should not logically, economically, in efficiency terms, have different prices. And that is what was there. One. Secondly, while the rupee was moving in value, you had a IT company here with exposure. You had a oil importing company with exposure. You had anyone with an exposure not able to hedge. Whereas the rest of the world, which had a rupee exposure, could hedge. I'm not even going down the line of taking a view. They could hedge. We had gap up, very large gap up openings and openings in the market. You never knew when you went to bed, literally and figuratively, what is the value of the rupee you would end up with. We were far away from the law of one price. So I think it was this that was in mind to put things together, have a single market for the rupee, give everybody an opportunity to participate just like anyone else. So there were two simultaneous announcements, one in January 2020, which said banks could offer rupee trades beyond trading hours, and then the one in March which came into effect that banks could also participate in the NDF market. I think if you put these two things together, this is broadly what was there in our mind. And let me add a third one. There are some of you who are branches of foreign banks. There are some of you here who are Indian banks. I'm sure if I were in the dealing room, I would be very unhappy if my counterparts overseas could deal in the NDF market and I couldn't. I've been a dealer myself, so perhaps this was the third part of it.
Ma'am, just a follow-on question. Now, after 5 years, almost 5 years, has that vision been realized in your opinion?
So I think two parts. As far as making it one price, if not a very close price, yes, that has been realized. What I'm less happy, at least personally, and I think I speak for my institution, is we haven't seen trades really move onshore. A large part of the volumes in the NDF market have been banks trading with each other, banks trading with market makers overseas. It's been true for foreign banks, it's been true for the Indian banks who are dealing with it. in fact, I would say the agenda would be complete when we see a much larger volumes of global client trades, end user trades also coming here. We haven't seen that. We haven't seen that absolutely, practically nothing of that we have seen. So all of you are here, I think, much more aggressive. Remember, and if I may add, what I see banks in India doing right now in the NDF market is basically arbitrage. So there's a difference in price, you arbitrage it away. I've seen one or two banks. One of them is sitting here on the dais with me, where I have seen client trades from, and that's extremely heartening. Remember, when more and more banks participate, the arbitrage goes away. What is actually left for the market makers as a whole to actually trade and make money from is the client trades. And I think I would like to see much more of client trades in the NDF market, see much more of Indian banks emerging as market makers globally, rather than just as liquidity providers and arbitrage profiters. I think that is very much work in progress.
Thank you, ma'am. The message is very loud and clear for all the traders sitting here, and I'm sure they will take up the challenge. Just on that, I'll like to address Mr. Prasanna. What has been your experience and learnings for one of the major Indian banks in terms of participating with non-residents in the onshore OIS and NDF markets, and how it has helped the Indian end users?
So I think, sir, first of all, when the regulator sits in the stadium, in the stage and talks, we should listen and we should accept.
So I have to say, he is not here, but Mr. Jaina and Prasanna being there, I know my legs are going to get pulled every single time.
No, but anyway, sir, to answer your question, I think if you look at the markets, half as traders and half as people who generate client trades. I would say that for all the FX traders sitting here, it's literally been a liberating experience. There have been times, I know, when you go home, like ma'am was saying, without knowing what the gapping risk is going to be, and the next day morning you're exposed to, you look at the offshore trades and then you figure out where the market is going to open. But at this point of time, we were actually able to, participate in that market. So for the set of traders, it's a wonderful liberating experience. And the frustration of not being able to participate in a market which is trading, which is your own currency, which you're not able to participate, is now gone, largely gone. But I have to agree when she says that are Indian banks really participating in this market on behalf of clients, or are they just trading and doing interbank market making with other banks who then are doing the trades with clients offshore? I would have to agree with that. So I guess there is a truth in that as well. And I think Mr. Ravi Shankar also spoke about that very recently. So our endeavor as part of our own bank has been to try and improve this kind of client positioning and client marketing as much as possible. But if you really look at it, sir, I mean, every market has hedgers who have underlying positions, but they're not able to have access to onshore, so they trade offshore. Then you have speculators who want to trade dollar INR through offshore mechanisms, and you have arbitrages as well. And there are 5 or 6 very clear reasons why the non-residents were not able to access onshore seamlessly. It includes documentation, it includes product suite, it includes timing, it includes even the kind of flexibility to cancel and rebook and so on and so forth. Now, like you rightly said, between March 2020 and somewhere around June 2021, so many guidelines have come which has now made sure that most of these drawbacks are not there anymore. So I think today we don't have, as market participant, any excuse in not, doing trades with non-residents, whether it's offshore or onshore. There are 2 curves available now, and like ma'am said, it's come down. The pricing difference has come down a lot, but there is still some marginal prices do exist. So in terms of our experience, I can maybe say just one thing and then, stop at that. When you have 2 different demand supply going on, you have a non-resident demand supply, then you have a resident offshore, onshore demand supply. And obviously because of arbitrages, the prices have evened out a lot. There used to be 70, 80 paisa difference between onshore and offshore at one point of time. Now, even if you get 7 or 8 paisa, you're very lucky. It's normally very much lesser than that. And in NDOIS, in OIS itself, it's just less than a basis point. But there are times when, because the rupee in the offshore market is more volatile than the onshore market, and one of the reasons, of course, being the presence of a regulator like RBI in the onshore market, there is much less volatility. I'm sure a lot of us will agree, and much more volatility offshore. So you have a much more volatility in the underlying market, because of which the implied vols in the offshore options are much higher. So a corporate today in India is actually able to, by virtue of the fact that the regulations now allow him to participate in that curve as well, is able to construct a profile, a risk profile, at a much cheaper cost than what he could have done onshore. So I think that is a direct benefit for a corporate. And also now with Indian banks able to, offer that corporate the offshore curve as well, it's a really truly liberating experience. So I think that's where I will stop for this, and then maybe but there are a lot of challenges on the monetary policy and all kind of things that RBI has to go through. Maybe if we have time, we can discuss that later.
Yeah, for once I am very glad that I'm the moderator over here and you had to answer this question. Otherwise, same question would have been difficult for me. So I'll move to Vijay now. Vijay, given the increasing participation in non-deliverable swaps and non-deliverable options, do you see any risk of these offshore instruments impacting the onshore forward and derivatives markets?
Okay, firstly, I would like to start off by saying that ED sir said that there is volatility in data interpretation. One thing we're all thankful with respect to regulatory reforms, there's no volatility. I think we set out on a journey a few years back, from a prescriptive to a principle-based approach. And what you've seen now is the markets have largely integrated to an extent where, in the morning traders will look at where offshore is quoting and then, start off where the onshore will start off pricing. But today the roles have actually reversed, where onshore sets the tone for the offshore market, and they actually start becoming much more active only when rupee market starts locally. With integration, volatility will move through, but it's not just, I would say, one-sided, it's actually both-sided. Obviously, the larger offshore market community, which kind of induces volatility and thrives on volatility, is the fast money clients, and they would trade crosses, they would trade relative value trades, digitals and barriers, which will automatically pass on to the onshore market because of the high level of integration that we have seen today. At the same time, it also moves in the reverse direction, which is in terms of, especially on the rupee rates market, where local corporates, etc., have started using the long tenor derivatives space. This kind of moves offshore. Market events like FX swaps, auctions, etc., which are more only possible in the domestic market, also has implications on the other side. Now, risk will continue to be there in the market. I think the key is the integration. And on the margin, if you look at it, given the two liquidity pools all broadly converge, it means any kind of event that we face from a domestic perspective or from an international perspective, as far as INR is concerned, it just evens out given the two pools that are available.
Thank you, Vijay. Ma'am, I'm coming back to you and with a slightly difficult question this time probably. While the decision made by RBI to allow domestic banks to participate in NDF market has enhanced liquidity and price discovery, but do you foresee, or does the regulator foresee any risks or challenges in terms of market stability regarding the participation of domestic banks in offshore market? And if yes, then how do we plan to mitigate those?
Let me start off with an anecdote which is got nothing to do with markets. I had a professor, I was an economics student, and I had a professor in Presidency College, Calcutta. His name was Dr. Deepak Banerjee. He incidentally is the father of Abhijit Banerjee, who a couple of years back got a Nobel Prize. I'm sure many of you know the name of Abhijit, at least knew him. Mr. Banerjee, Professor Banerjee was one of those most outstanding professors, and an extremely sarcastic sense of humor. So I had a colleague who used to be absolutely scared of Professor Banerjee and would always try to find the tallest or the widest student in the class to sit behind. So one day, Deepak Babu, as we call him, he used to teach us microeconomics, and he stopped and he walked forward, went and stood next to this student who was trying to hide, and said, "You know what an ostrich is?" And we were all flabbergasted. So he said that the ostrich buries its head in the sand, and it thinks that if it cannot see anybody, nobody can see it. So I think to a large extent this was it. The markets were there. Whether we take cognizance, whether we allow our banks to participate, the risks were coming. As Vijay mentioned, it was a one-way risk, now it's become two-way risk. So I don't see any additional risk as such from banks participating. We have a prudential regulatory framework in place. Noop limits are there. Nobody goes beyond the noop limits. There's a market risk, there are capital limits, etc. We have, I think, tried to put in place very well-defined limits for market making, for, now variation margin has come in place and initial margin will start. So I don't see the counterparty, whether it is domestic or whether it is, it's an overseas counterparty, really adding to risks. On a macro basis, volatility, I think the risks which are there continue to be there. I just have a feeling that by removing the segmentation, we actually manage them better. Or we give banks the ability to manage their own risks better. And I think at a macro level also risks are getting managed better. So just by way of banks participating in offshore market, by itself, I don't see any additional risks. I think sufficient prudential, regulatory and surveillance tools are in place. I'm sure many of you very often have got a call from my surveillance team to ask why, what is happening and what is the reason for that. I think they're enough. I don't see any specific additional risk out of our banks participating in the offshore market as such.
Thank you, ma'am. That's very comforting to hear. That's very, I think, so that means the activity of Indian banks also has increased and they have reached a level whereby the confidence of the regulators is with them. So that's good. Coming back to Prasanna ji, the integration of offshore, inshore, and the domestic market, offshore and onshore market has happened now for 5 years over a period of the interest rate cycle. What do you see the policy ramifications of all that?
So I think ma'am was talking about there being very less risks in Indian banks participating. I do agree with her on the market side, but somewhere I feel that on the policy making side, there is some repercussions which have happened. Let me try and explain that. So there are three ways, I think, or three methods by which the Reserve Bank or any central bank for that matter can intervene in currency. So let's assume that there is no NDF and Reserve Bank intervenes in the onshore market. The repercussion on liquidity is clear and known, so they have to have a solution ready for what they want to do on liquidity. Suppose they are doing it on NDF. NDF is actually just a bet on the currency, and it's quite possible that RBI does what it wants to do in the NDF market, influences the price there, but just closes that bet by either receiving the profits or paying the losses and with no impact of liquidity in Indian markets. This is if Indian banks are not allowed to participate there. But now that Indian banks are allowed to participate in the NDF market, any action by the Reserve Bank on the NDF side, because Indian banks are actively arbitraging, also translates into a liquidity problem into the Indian market. So this is, according to me, is the only change or the only, should I say, repercussion of the fact that we have allowed Indian banks to participate. So nowhere am I saying that it's not a good move. I think it is a good move and I think it is a necessary evil, and that's the way I think about it. And let me also explain different cycles you had asked in your question. So the interesting thing is, whatever, let's assume in a cycle where dollars are flowing into the country, RBI, buys those dollars, sells rupees, then it's giving liquidity into the system, but it doesn't want that liquidity, so it postpones it and hence pays forward, but does a buy sell and pays forward. Forwards go up, and Indian banks find it very attractive because they can now sell dollar here and buy dollar abroad. So they are actually exacerbating the situation. That's when dollar comes in and when RBI is buying dollars. The same situation when dollar is going out and RBI is selling dollars, exactly ulta happens because they are now receiving forwards. So again, it becomes attractive for the Indian banks to do what the RBI is doing in the onshore market. So the problem for RBI is much more. So what it effectively means is when dollars are coming in, the reserves of the Reserve Bank are going up by more than what the real money flows are in, because Indian banks are also arbitraging. And similarly, when dollars are going out, the reserves are falling much more than what the real money, investors are determining the. So I think the problem is this is an asymmetric problem. You don't mind reserves going up as much as you want, but you have a problem when reserves fall. So that is the reason why we have seen so much of activity over the last 2-3 months. This, according to me, is the only repercussion. But I think as an economy, as a institution, both the central banks as well as all of us in the markets need to be prepared for. We understand these risks, and we need to be a part of the system in order to undergo the kind of transition that's happening.
Yeah, thank you. You have put the risk clearly. But I believe the regulator, I am not going to ask ma'am, but I believe the regulator is fully confident of meeting this additional risk, as well as the confidence in Indian banks' ability to support RBI. But coming to volatility and the things which can lead to it, Vijay, what can be the impact of US tariffs on USD INR pair? Do we need to take any steps to reduce the impact on Indian FX market? And this is going to be a tricky one. Where do you see USD INR in next 6 to 12 months time horizon, since foreign inflows have been lackluster in most of the emerging markets, including India?
Okay, firstly, obviously before the impact on dollar rupee, I think the uncertainty is largely on the tariffs in itself, right? So maybe let's spend some time from an Indian context, right? Because it's spoken so often. But purely from an India-US relationship, let's just take a step back and look at it in terms of how do we quantify this. And our economics did a detailed note around the India-US relationship. I mean, clearly as a trading partner, US is super important. I think trade, we are like close to 18-20% of our trade goes to US, and services is much more. Contra on the US side, I think we are significantly lower from a trading partner from a US standpoint perspective. Tariffs in India in general in terms of percentage has been growing significantly. We used to be in the 6.5-7% region and moved to closer to 12-13% region. But a large amount of that is actually coming from tariffs on agri and agri related products that have happened. Now, obviously, the conversations with the two governments have continued over the course of the last 1-2 months. Some measures have already been taken as far as India is concerned. The bigger ones, obviously, which we want to look out for is in terms of changing the complete equation would be on the energy side and of course on the defense side. The number, of course, in terms of trade def is close to $45 billion odd, which US is earning against India, which is a number which has been growing significantly. I wouldn't say significantly, but at an increasing pace over the last many years. Now let's look at what are the options available from a US perspective, right? I mean, you assume the worst case and say, okay, what if the retro tariff is exactly equal to what India is applying, and then obviously it means a detailed analysis of, I think we did close to 1,200 goods and see how the tariffs are between these two countries. And if you come to, let's say, an equal and retro tariff, the impact on the margin is close to $7 billion odd as far as the trade is concerned, which is close to 0.25% of our GDP. I think the bigger impact, which is broadly going to be on the uncertainty of tariff and how it's going to affect globally, right? In terms of how global trade balances kind of start shifting, and that could have a larger ramification onshore, which is concerned, which is more in terms of supply side shocks, and that's the private investment cycle. That for us is probably a larger worry as far as the tariff is concerned. Now, again, on the dollar rupee side, I think slightly, I would say much more factors kind of affected. We had put out a note of 89 on dollar rupee when dollar rupee was actually at 84. Few factors which we considered at that point of time. One, obviously, being the US exceptionalism. Second one, in terms of our own RER, which RBI measures. At that point of time, we were closer to the 107, 108 kind of levels. We also had to look at how China will react in terms of US tariffs. And lastly, our own BOP, because ultimately I would say, BOP change would probably be a reflection of the RBI reserve change also, and also in terms of where dollar rupee should trend overall. From there to now, I think few things have changed. From a US exceptionalism, now the conversations are increasingly moving to even decoupling. We've started actually flows starting to come to China in EM. As far as absolutely, if you actually look at how China has reacted, I mean, they have taken 20% tariffs, but they haven't really moved out as far as the currency is concerned. Our own currency in terms of RER valuation has now broadly come to around 80, 102, 103 levels, where we are today. The last one, which is quite slightly difficult to predict, is in terms of the EM flows on India in itself. After having a bad, Q3 and on the Q4 also, it's not starting off on a great note. The equity flows have been broadly negative, and they continue to be negative as far as India is concerned, which is a risk factor for us broadly. I think on the debt, we have continued to do well. Most people actually put out when the bond index inclusion actually came out, around $25 billion to $30 billion of flow to come in. We had 15 odd roughly last year, 5 already has come in, and if we have time till the next June, till the balance, the rebalancing actually happens, we'll probably reach the 25 billion number. With this in mind, I think, short term, we feel March should be probably 87, 60, 70 as far as March end is concerned. But beyond that, the equity flows can be quite heavy, and that can actually push dollar rupee to closer to 89 again. And it's very difficult to kind of now give a 1 year kind of a view or a longer tenor view on dollar rupee. But I think these are broadly the risk factors market should watch out.
You said that equity flows may resume after March, or you said they will further
I think
strengthen?
the equity flows, again, one is
Inflows.
obviously in terms of valuation. When we speak to our global clients, right, when it comes to, I think the debt flows will continue. I think that is kind of sticky. There's a predictability pattern to it, which will happen. Equity one, when we speak to our, FPI clients, etc., well, it's still on the margin, I would say slightly negative only. Valuation conversations have actually started, and the recorrection has happened in terms of forward P, etc. I think what has been reassuring for them is two things. One is actually the GDP print, like bottoming out. There is expectation from the CUM, etc., in terms of the numbers panning out. The budget in itself, especially on the retail side, in terms of the tax reliefs that is given. So all in all, I think people are now starting to turn the tune into being slightly positive. Numbers are yet to show, but I think that's it's very difficult to predict as of now. We'll have to kind of wait and watch. But clearly, this decoupling that we are seeing on US, that will have a positive benefit as far as India is concerned, because people are now starting to get slightly tired in terms of X in the morning, tariffs, Y in the evening, and then you start off another day. So you'll probably see that trend to continue for the time being.
So you mean to say the earnings will be the key. Thank you, Vijay. I'll change gears a little bit, go back to ma'am. Ma'am, what are your thoughts now on bringing in more efficiency in NDF market by having better and robust infrastructure for NDF trades, especially availability of anonymous platforms and more transparency in the markets?
I think it's more of a question for CCI here, but from our perspective, yes. I mean, we are. It's a global move, but I think from our side, we are happier the more and more transactions go on trading platforms, go on central clearing. All of you would be aware now. Recently, CCI has moved FX forwards up to 36 months. I understand now, earlier it was 13 months, now up to 36 months are being centrally cleared. I understand that's about 99% of all the forwards. ET sir mentioned FX options, there's also a trading platform. I think CCL is also working towards an NDF thing. Let's see how it pans out. There aren't so many trades actually. It's few banks just trading with each other. One leg of the trade is outside the country with an offshore one. So to what extent it's going to be feasible, I think all of you can work with CCL. If it is feasible, I'm very sure. I mean, it'll definitely have a blessing if it adds efficiency to the whole thing. But there just has to be sufficient number of trades and sufficient participants for that to really work.
I think, ma'am, we have a CCL presentation after this panel. So somebody may ask or we may ask this question to them. Coming back to ICICI Bank and Prasanna ji, once again, with 5 years of experience, what is your estimate of India and Indian banks in offshore markets? Can we improve this, and what are the challenges you foresee?
So before I answer that question, sir, and since Vijay spoke at length about the view on the dollar rupee, and when Mr. Rammohan Rao was talking about Trump tariffs, he was talking about how can you do an analysis when you don't know what is he going to put a tariff on and how much is he going to put it and whether it's going to stay. And also when Mr. Rato said about volatility in the sentiment itself and the volatility in interpreting data. So what I remember is an anecdote in my own boardroom. The joke is, whatever the question is asked, I give the answer, it's because of Trump tariff. So they asked first day, why are the bond yields up? I said, because Trump tariff will create more inflation, bond yields are going up. Then they asked, why are bond yields coming down? Then I said, Trump tariff, because the growth is going to take a hit, there will be interest rate cuts, so bond yields will fall. Then gold went up. So they asked why. I said Trump tariff. So it goes on and on. So now they ask the question and they say, yes, I know, Prasanna, it is Trump tariff. So that's the extent to which
let me make an observation. I believe you are the only person who is benefiting from Trump tactics.
Because we don't need to do the analysis. We just need to tell about him. But, sir, on the aspect of NDF and what can make it better, I think ma'am hit it in the nail in the beginning itself when she said that I think the observation is that Indian banks are broadly doing arbitrage. And so when Indian banks are arbitraging, it's not necessary, it's not, of course it is good, it is helping the price kind of get unified, but it is not necessarily the maximum to which a particular market can go. And the other thing about this arbitrage is that Indian banks predominantly, I'm saying, not everybody, I'm sure there will be other people as well, assume that you buy at a spread and hold it to maturity. At maturity, the spread will be zero, so you make money for sure. But then the point is, it is not a linear transition towards zero. There is a lot of volatility in the basis spread itself. So what that effectively means is that sentiments and the fundamentals also determine the kind of spread that exists on a daily basis. And the differential sentiment between global investors and Indian real money participants can always be different. So I think we should get into a little bit of market making on the spread itself. So it's the basis market making, and that will ensure that Indian banks can trade between themselves as well. Today, all the Indian banks are on one side. Either they, receive and make the arbitrage, or pay and make the arbitrage and hold it to maturity. Now, in between, if you are forcibly asked to exit your positions, which, the call can come anytime, then you are going to, lose out on that. So, in fact, ma'am, during those times, it's when we hope that our phones don't ring. But anyway, so that is a challenge, sir. And but in terms of the good things that have happened, like I said earlier, the spreads have come down a lot, and it's now very, very within manageable limits. And so that is something which is good. And I also noticed that a lot of volumes are happening predominantly in the up to 3-month maturities, and beyond 3 months is hardly anything. But then if you look at the global, experience, that seems to be the global experience as well. And the power of speculators in trading, speculators typically trade the shorter end, and it's the hedgers who take positions in the longer end. The power of speculators is a multiple of hedgers. So I think that process is also playing out in India as well. So I guess the process has started, it should go on. And while there are challenges like on the monetary policy side, while on challenges on how Indian banks manage clients' requirement, I think we need to, kind of get over it. There could be a lot of requirements like KYC. Like our international clients, we do have offices in Singapore and Bahrain and Hong Kong. International investors, their clients, they always prefer to do their deals there rather than do it here, and clearly the KYC requirements are different. So I think these are some of the challenges that we might want to look at as we go forward.
As RBI has permitted domestic corporates, those who are eligible to trade in NDF, maybe that can also help if they pick up. So far, those volumes are not too high. Coming to Vijay, and this is going to be a question which everybody would like to hear the answer to. What are the global banks? You are one of the global banks, one of the top 10 banks. What are the global clients' views and experiences around onshore dealing with the numerous regulatory enablers which have now been put in place?
I think let me start off by saying it's been immensely positive, especially because bulk of the clients are real money clients who would be accessing India. I mean, earlier it was challenging in terms of you can cancel and rebook up to only 1%. So everyone would be like putting on their spreadsheets how much they have cancelled, how much can rebook. I think we have come a long way from there. Now, if you have to broadly, let me just cut out the global clients into three parts. The first one is probably fast money. In terms of fast money clients, I think the key things that they kind of hit a hurdle when it comes to dealing domestically. One is I think taxation. Many of them are actually Cayman registered. So when you kind of want to deal onshore with some of these clients, because there's no treaty, the withholding tax can be as high as 40%. So that's one hurdle that we see with fast money clients. Now, what is I think what can happen and what is beginning to happen there is in terms of dealing with these clients from the IFSC branch, where the tax implications are actually broadly negated. The second one is the entire FX prime broking setup, which is there on offshore, which is not really there onshore. But LCH is actually an option. It kind of negates to some extent the taxation implication. Also, the KYC is all still there, but as more and more Indian banks actually participate in the LCH, where majority of these transactions are cleared, it will definitely make it easy for them. The second one is real money. I think increasingly they have started adopting, including many sponsor clients in terms of, whenever there's a bid type of situation where they want to kind of hedge. I think now the conversations are clearly starting to become onshore, where they can actually do on anticipated exposure as well. The KYCs, etc., yes, it remains a challenge. So the starting point will obviously be your FPI clients, where any which ways they've done the KYCs as far as the locally to access the Indian bond or the equity markets to make it slightly easy. It is going to be a journey, in fact, and it's a very hot conversation with even all foreign banks in terms of when we have a regional sales coming in terms of how do we kind of make India as the one-stop shop for both deliverable, non-deliverable, and access all the global clients sitting out of India. But it's going to be a slightly, I would say, it's a journey. It's not going to happen overnight, and most banks are, I would say, are up to it. The last one I think is banks, and I think there's been fantastic participation as banks have concerned. So while we want each of these clients to actually participate and come into the onshore market directly, I think banks have now taken it upon themselves to act as a bridge. Eventually, as we start unlocking each of these issues one by one, we will see a seamless movement from offshore to onshore. I don't think will it be ever 100%, no. But I think if we start getting in the high 70s to begin with, I think that'll be a good thing to achieve. And it's broadly upon us market participants to make that happen at this point.
Yeah, I believe, Vijay, you're right, but the conversation as well as the intent of the government and various regulatory bodies to ease the pain of KYC process. It's only the process. KYC is a known fact. All regulators across the globe would require it. So the only thing is maybe that process, if it can be streamlined, made more, maybe simpler or more painless. I think that's going to...
It happens, right? Because when the bond index inclusion happened, I mean, at least we had more than 800, 900 FPIs, each of them registering, and and it's also how the clients also react to some of these things, and over a period of time, they're actually now seeing that yes, KYC is been a challenge, but if you have to access Indian markets, then you have to get over it. So you'll have to give some of these large global clients a bit of time. Especially if you see a number of sovereign wealth funds who have started accessing is increasingly increased. Broker dealers are participating. As I said, it's going to be a journey, and it's on us banks to explain to them to untie all the knots that are there with respect to the KYC process.
Right. So I believe the onus is on us to educate them and tell them what is one problem. Ma'am, coming back to you once again, what is your thought on NDF markets being used for speculative purposes, which can lead to increased volatility in onshore currency markets?
My first thought is I should have asked you to remove this question with my boss sitting here. But uh, okay, strictly, if you ask me, and at least the work which in the Reserve Bank we've been trying to do on the regulatory side, last 4, 5, 6 years, I think the broad thought process is a very simple thing that markets exist for hedges, markets become liquid by speculators, and markets become efficient by people who arbitrage. I don't think I need to explain this to the audience here. So, a certain amount of speculation, if we want our markets to be liquid, it has to be there. Now, that speculation can take various forms. I mean, let's say you have a corporate now, free cancellation and rebooking is allowed. The corporate has underlying, the corporate can hedge when it wants to. It feels the rupee is going to move in a particular direction. It cancels, re-hedges. This is speculation, taking a view on the rupee. Every entity has a choice of remaining unhedged. You could say that is also speculation. You're taking a view that the rupee is not going to move against your favor. So now it's about banks doing it. And frankly, we have, as I mentioned earlier, we have limits in place. We have the NOOP limits in place. Most of you have board-approved NOOP limits, which is well below what is allowed by the regulations. Difficulty sometimes comes when, as Prasanna mentioned, all Indian banks are on the same position. And instead of profiting from the world, you're trying to profit from RBI's actions. So I think maybe there we could have a little bit of concern. But broadly, I think within the set limits, all this is part of the market. Let me not say more before I get myself into trouble.
Thank you, ma'am, for being so candid. Now, probably the last question, because I am already seeing some glances from that side. The same question for both of you. I may want to make my life easier. Prasanna ji first. Are there any asks you have from the regulators or the members which could help in expanding Indian banks' roles in these markets?
No, so I think Vijay spoke about onboarding and KYC requirements. That's something. Simpler and predictable tax laws. These are two things which are we think we should try. I mean, it's a motherhood statement, I know, but I think we can work towards each one of this. Also, review withholding tax on interest paid on the bilateral postings that happen. I think that is also something that is not, that's a kind of a pinprick for people who do these bilateral postings across geographies. The other thing is, encouraging foreign banks to run a much bigger position onshore, I think is something that, that's the broader thing that we should do instead of them running positions abroad. And for that, I would say that the regulatory nudges from the Reserve Bank should come down. Over a period of time, we should be allowed to run positions. And the LEF framework, which has been a hindrance for foreign banks running a bigger exposure, I think that is something that works. Just one more thing, sir, I'm not very sure about this, but the PFE exposure on CCPs, banks are doing it on gross basis and not net basis, which is kind of an irony because when you do a bilateral, you can do netting, but when you're trading through CCPs, you have to produce capital on a gross basis. I think this is a quirk of irony, I would say. So I think these are 3 or 4, maybe one of them are nitty-gritties, but broadly conceptual asks.
That's quite a long list actually. In so many short words, you have said that. So Vijay, though he has answered most of your questions, your wishes also, but what would you like to add to the list?
I think nothing more. I think in terms of foreign banks, I think LEF, yes, especially in terms of derivatives, this is something which is slightly unique to India. So the ability to do back-to-back hedges with global clients get significantly constrained because of these limits. But at the same time, we're trying to work out with the clients in terms of directly accessing LCH as an example, or getting the clients onboarded to deal onshore. The other one, I think obviously the initial margin, again, it's more the regulations are out, it's more for the industry body, including ISDA and the market participants and CCIL to get on board. I think that will go a long way in terms of freeing up capacity for banks to do, foreign banks especially, to do transaction with a number of, especially Indian banks and in some instances clients, because the global regulations for us are already live. right? So the it's a bit of a binding factor at our end, which hopefully this quarter we kind of cross the hurdle.
It's been a great learning experience actually. So many questions. I believe some of them probably starting from the history, going to what is going to be in the future, what is present. We have discussed all that, and some asks already have been made from the people in this room, in the big room which we have. So I believe all of us would have. Do we have question answer or we don't have? We don't have. He says we don't have, time is not there, and especially since coffee break is there. So what I would request, if anybody has a question from any of the panel members, at your own peril, you can ask them during coffee break. But I really appreciate all three of you being here, answering all the questions. It's been wonderful to have you here, and we got some good insight. Thank you.